the pattern day trader rule in detail. Back in 2001, the SEC instituted a new rule known as the pattern day trading rule. This was in the wake of the dot-com bust, and regulators felt it was needed to help ensure that traders with smaller accounts would stop losing it all quickly by day trading. After trying swing trading and day trading for many years, I would say it's probably a good thing and not a bad rule for most traders. I've made a lot of money swing trading over the years, but lost overall while trying out day trading. The performance is like night and day. I was successful almost immediately when I tried swing trading top growth and up-odd stocks early in my career. But whether you trade a small account or one over $25,000, you need to know what the rule really is and what could happen to your account. You also need to know how it works whether you day trade with a larger account or even if you swing trade with a tight stop loss. There is a lot of disinformation online about this critical and sometimes scary rule to new traders. So let me clear up some confusion. The pattern day trading rule in detail. The pattern day trading rule is a mechanism where pattern day traders, a trader who has made more than 3 daily round trips over a rolling 5-day period, are only allowed to trade if they have over $25,000 in their account. The rule only applies to margin accounts, basically an account where you can borrow money from your broker to buy additional shares, or a broker where you have instant settlement such as Robinhood. Margin accounts allow you to use the funds from a stock sale immediately rather than wait for the 2-day settlement period. The most important thing to know about the PDT rule is that you do not want to have the pattern day trader flag on your account. So avoid doing more than 3 daily round trips over a rolling 5-day period. Why do I say this? Well, if you have the pattern day trading flag on your account, and the account goes below $25,000 before the market opens, you are stuck. You can only close existing positions. Yes, you read that right. Your account is basically frozen. You cannot trade again. You can only close existing positions. Not sure why no one else mentions this online, but that is the way it works. Of course, your broker will tell you no problem, just add more money to your account so you have over $25,000 by the open of trading the next day. This is what usually happens to new day traders multiple times during their first few years. They keep adding and then losing it. If they become really great day traders, which generally takes many years unlike swing trading, then it probably will not be a problem. However, even if your account is well north of $25,000 and has the pattern day trading flag, one trading halt on a stock and you could lose a ton, especially if you use margin, and be stuck being able to close existing positions only. This is a real risk of this when you trade stocks under $10. Not where I want to be. Now, if you do not have the pattern day trading flag on your account, being under $25,000 is not a problem. If you have less than $25,000 in the account and do not have the pattern day trading flag on your account, you can swing trade, hold each trade at least 1 day, as many times as you like. You can also do up to 3-day trades, 3 round trips on the same stock the same day, over a rolling 5-day period. A day trade or 1 round trip means there is an executed buy order and sell order for the same stock on the same day, whether it's pre-market, during normal trading or after hours. Here is a good example so you know what a day trade or round trip is and how to avoid more than 3 same-day round trips within a 5-day period. Remember, once you have more than 3 within any 5 trading days, your account will be flagged as a pattern day trading account. A flag that generally does not get removed. More about this later. Here is a good example so you know what 1 round trip really means. Let's say you buy 1,000 shares of stock A and sell 500 shares of stock A twice the same day as you bought it. That would count as only one round trip. It's counted as only one round trip because you have 2 executed sell orders, but only 1 executed buy order on stock A. If you buy stock B on the same day, but do not sell any shares of stock B that same day or vice versa, it's not counted as a daily round trip obviously. Have 2 executed buy orders and 2 sell orders the same day on the same stock, and it would be 2 round trips. Or, if you buy and sell stock A and also buy and sell shares of stock B that same day, and you would have 2 daily round trips. Again, you can only have 3 daily round trips over any 5-day period, that is 5 trading days, not calendar days. Over 3 and you get the dreaded pattern day trading flag on your account for good. Once your account has the pattern day trading flag, it's frozen to closing transactions only if the account value is below $25,000. You cannot start any new position. Your broker should give you account of the number of day trades you have left at any given time before you get flagged as a pattern day trader. Thinkorswim has a day trades left counter built in, but you may need to customize your account info widget in the upper left of your trading platform to view it. But once you have the pattern day trading flag on your account, you cannot even swing trade if the account goes below $25,000 by the start of trading the next day or is already below $25,000. Your account is frozen. A good online broker will give you a message when you have used up all 3 of your day trades within a 5-day period. Again, none of this is a concern if you stay over $25,000 in the account or add more so it's over $25,000. You can day trade all you want. But once you go below $25,000 before the market reopens, your account is frozen again. Only if it is the pattern day trading flag until it's back over $25,000. The most important thing to remember. Here is a critical distinction. Remember this. The flag does not come off once you get your account back over $25,000. So one trading halt or big loss of any kind could bring your account below $25,000 and restrict your account to closing trades only if your account has the pattern day trading flag. So the PDT rule is a big consideration for many retail traders, especially for day traders, since swing trades are held overnight and will not trigger the pattern day trading flag on your account. Ways to protect yourself from the pattern day trader rule. 1. If you have the pattern day trading flag on your account, one thing you can do is ask your broker to remove the flag because you are using a different strategy. Hopefully, a swing trading strategy. Regulators will allow your broker to remove the pattern day trading flag once every 180 days. So you can call your broker and say you are using a different strategy now and ask them to remove the flag. They will not be able to remove it again for another 6 months, so it's a good idea to use a great swing trading strategy and have at least 1 day trade left so you can exit a position the same day if it goes against you quickly after you enter. Always keep track of how many day trades you have left within your trading platform. 2. You can use an offshore broker like SureTrader. Offshore brokers are not located in the U.S. and are not regulated by the SEC, so the pattern day trader rule would not apply. Overseas brokers are great because they have less regulation. They are also more risky because, you guessed it, they have less regulation. The only experience I have with SureTrader is with someone who was having a hard time matching the entry and exit prices in the 3 stocks to wealth strategy on investtobefree.com. We have a performance tracking spreadsheet where traders can quickly pinpoint poor fills to ensure they can closely match the performance before commission and fees. This is the only email I have received from someone who had a problem matching the fills. I asked them what broker they used and they said SureTrader. It could just be a coincidence, but you want to make sure your online broker is able to give you good fills. You also want to consider whether you should have your money with a less regulated offshore broker in the first place. 3. Another way to protect your account from the pattern day trading rule is to use a peer-to-peer broker such as UStockTrade. However, some stocks do not have enough peer-to-peer volume to trade using this type of broker. 4. You can also choose to use a cash account rather than a margin account when trading. The PDT rule only applies to margin accounts. However, this usually requires you to wait for the 2-day settlement period before entering your next trade. If not, then it's likely some form of margin account, and the PDT rule will likely still apply. This may be the best option for many traders. However, if an ideal opportunity comes up the day after you exit a trade, you will likely be out of luck because you have to wait 2 days to enter your next trade with the funds received when you sell a stock, unless your broker has a policy where they front you the money for the next trade before the trade settles. Also, this opens you up to possibly running into a good faith violation or other violation if your broker fronts you the money for your next trade. This could lead to problems like having to deal with a 90-day settlement period. 5. In my opinion, the best way to avoid the PDT rule is to swing trade the best stocks out of the best technical patterns. Swing trading stocks under $10 is not the best idea, as my experience over the past 10 years and every backtest I have performed shows a lower win rate on stocks under $20 and especially under $10. Swing trading stocks under $10 is especially problematic as they often do secondary offerings after the stock has moved a lot higher. This is especially true on stocks in long-term downtrends such as shipping stocks. So what often happens to newer traders is that they jump into a trade on a lower quality stock under $10 only to have to make the unfortunate decision to either get out of a sinking ship or have their account frozen. That is why we focus on better quality growth stocks that are almost always over $20. The PDT rule can be very problematic once you have the flag set on your account. Even if you have a larger account, day trading can quickly shrink that account below $25,000, which freezes your account immediately for new trades of any type. Another reason to learn a great swing trading strategy instead, such as large triangle breakouts within very entrenched long-term uptrends on top stocks. Beginner traders should be thankful for the pattern day trading rule because it forces you to be very selective in which trading opportunities you take part in. This is a key to success for most newer traders. We like to trade only the very best opportunities, such as Roku breaking out of a high tight flag not once but twice this year before over 30% plus gains within a couple weeks. Keep in mind that your account size does not matter when you swing trade. The pattern day trading rule only applies and freezes your account if you have 3 same-day round trips within 5 trading days. So be sure to always keep tabs on how many day trades you have left. Again, your trading platform should be able to give you this information. Of course, the PDT rule will not be much of a concern at all if you choose a longer-term swing trading strategy such as the ones taught on this site and the opportunities featured in the alert service. These strategies are the most successful ones we have found over the past decade on top stocks on any price stocks. They can also easily be executed while working full-time with more peace of mind. The strategies fall somewhere between buy and hold and day trading and will allow you to easily avoid the pattern day trading rule and take advantage of higher percentage trades at the same time. Hopefully, you have a better understanding of the pattern day trading rule. Feel free to leave questions below and we can answer them for you. Thanks for listening.